to walk us through just the moves that we're seeing. This Nancy Pelosi trip to Taiwan obviously is bringing up a lot of this kind of geopolitics back to the forefront. How do you see these moves right now? Are they long-lasting? I mean, markets are pretty not too great when it comes to pricing and geopolitical risk.
Almost by definition, it's impossible to price in, particularly the timing. Personally, I don't see a huge foreign policy reason or motivation for this visit. I do see a domestic politics dimension, which I suspect is driving more of the motivation than the foreign policy side. To that extent, I suspect the spike in risk premium is likely to be short-lived. I mean, inevitably, we may see some additional response by the mainland authorities to make their point, including possibly an acceleration in flyovers. But I suspect this will be a short-lived spike in volatility. I don't see an enduring risk associated with it. But it just adds, I think, to the overall cloud that covers China risk more broadly, and I think that's likely to endure perhaps a little longer.
Well, I mean, there are many things to talk about. I would imagine there's a lot less things that matter to markets. It could be this, it could be something else. Is it time to be adding risk right now?
To China, I suspect those investors wishing to add risk will be focused more on the policy response. We've heard today particularly the focus on a GDP broad target rather than an explicit defined goal. And of course, Li Keqiang guided and alluded to that 2 or 3 weeks ago. The fact is that the government is going to have to unleash a substantial amount of stimulus even to get close to that 5.5%. And that's one of the reasons investors are focused on China. There is this broad view that the level of stimulus is likely to leak over into the broader market, particularly the equity market. And I think that's one of the reasons why we've seen such a substantial outperformance versus developed market benchmarks since the mid part of March. Admittedly, the spectacular rally by the S&P and US markets more broadly during July has clawed back some of that China outperformance, but 5–6% of that still remains. And if investors are in China for a longer strategy than perhaps maybe 2 to 3 months, I do think there's upside, particularly as we focus on the senior leadership elections in October, November time.
John, great to see you, by the way. Just give me a sense of how you look at the banking system in China and the property sector. The real estate market, of course, is spilling over. We've seen these mortgage boycotts and beyond, and these things are gathering momentum. Does this really represent an existential crisis for the banking system in the country?
The short answer is no, I don't think so. It's important to point out that China's property sector is the largest single asset class in the world. And of course, the China banking system is essentially funding that. The 3 red lines, the so-called deleveraging policy, has put an extraordinary amount of pressure on that sector. But, Rish, I wouldn't be at all surprised if at some point the 3 red lines become 3 pink lines as those leverage restrictions are diluted somewhat and banks and developers are given a little more breathing space in seeking to bridge this challenging gap that they have. My own view is that the government has the flexibility and the ownership of the banking sector to withstand some of these solvency challenges. And to that extent, I'm not looking at this as a systemic crisis or an existential crisis, as you put it.
So, I mean, hard to see if inflation's peaked, but is it time to start pricing this pivot from the Fed?
Yeah, I think the coincident economic data is telling us one thing, and the markets being 3 to 6 months in advance is telling us another. So if you look at the CPI, the headline CPI data, clearly that is ticking higher. The market is saying, let's look through that. Let's focus into the second half, maybe even to the first quarter of next year. And we've seen a repricing of Fed fund futures. We've seen a repricing of bond yields. Break-even rates are all telling us that peak inflation is yesterday's story, and today's focus is very much on growth and essentially the probability of recession.
But what if What if inflation peaks and then we just kind of stay plateaued? How sticky is inflation on the way down? And what happens if it is pretty sticky?
And that is precisely the question that is being debated now. Certainly, I think inflation will tick lower. There's no doubt about that. And commodity prices are telling us that supply-side risks are diminishing. But absolutely, from a demand side, inflation will not go back to the levels we saw pre-crisis, pre-COVID. And we will see an enduring premium, the level of which is yet to be defined, which suggests to me that inflation rates are going to remain, interest rates will remain elevated. And this stagflation risk, I think, is likely to become somewhat enduring, if by that we mean an elevated sense of inflation and a lower rate of growth. I mean, Credit Suisse now is assigning something close to a 25% probability of recession. Technical recession, of course, we are already in. But if you look at the broader definition of being a rise in unemployment and a reduced level of growth, then I think that's something that is more likely. Again, the only debate is it a soft landing or a hard landing?
John, with all that in mind, the US economy does strike one as being a bit of a curate's egg, good in parts, terrible in others. No wonder people are confused and thinking and asking, does the Fed know what it's doing?
Well, I think that's a reasonable question, particularly given the amount of stimulus it injected into the economy at the start of the COVID crisis. I mean, for context, M2 money growth accelerated to the levels we last saw in the Second World War. Now, admittedly, we've seen a very sharp contraction in M2 since then, and naturally we would expect to see a commensurate decline in inflation. But yes, there's been a big debate about whether the Fed is behind the curve. And I think actually by front-loading rates, by this expectation that we will get to, say, 3.5% by the end of the year, possibly 3.75 in the first half, there is a sense that that's probably close to the terminal rate, Rich. And I think beyond that, we would start to see expectations, ironically, of some consolidation and subsequently rate cuts.
The investment advice is what? And is there also room for, I guess, on, let's say, 60-40, for example, longer dated bonds at this point?
Well, you know, David, the performance of markets until the end of June really was an intergenerational phenomena where bonds, equities, commodities, except oil, currencies against the dollar, all traded off. The month of July saw that reverse almost entirely in terms of a complete flip in performance. So absolutely, it's very much focused on balanced portfolio construction with a focus on time in the market, because these months like July can whip a portfolio apart and inject substantial amount of volatility. So we have to be focused on particularly the benefits now offered by investment grade. Bond yields have been ticking higher relative to last year, and this to us offers an opportunity to get invested and focus on investment grade. I think that's one of the key takeaways.